Hey, everybody. Good evening. We are sitting at Sunday night. It is 8 p.m. Eastern, and we have a big week in store with a lot of earnings coming up. It should be a huge week. Wanted to go over where the market's at, what we've been seeing, and what I think is a good plan for me to have as we enter the week. It's going to be a big one. We've got some big earnings. I'll talk about those in a minute. And I appreciate everybody being on. And Shadow Guy, thanks for tuning in long enough to say goodnight, I guess. And I know it's really late in Europe. I appreciate you just putting the comment out there. Hope you have a good evening as well. Niche Hicks, thanks for joining. Appreciate it. Hopefully you're having a nice weekend. And you guys are watching the football game. It's a little bit of what was expected. It looks like the Chiefs have a pretty strong grasp on the AFC Championship game, and the Philadelphia Eagles won the NFC. So the Eagles are in the Super Bowl, and we'll see whether the Chiefs or the Bills make it in. Right now, it's looking like the Chiefs are going to be attending another Super Bowl because it's up 21-10 over the Bills going into the half. So we'll see what happens there. Carlos, thanks for joining. Very good to see you again. So I'll go over some earnings stuff. Let me know if there's some stocks out there you want to talk about. Be glad to cover those and give you my comments on them. So looking at the futures, and these are not the most reliable, right? But it's interesting to see. If anything, what's the sentiment on a Sunday night as we look at tomorrow's trading? The Nasdaq's selling off quite a bit. S&P, because the big caps are in that index, is selling off a bit. The Dow's kind of holding its value, so that looks good. Crude's down a little bit, so that'll affect the big oil companies. And no way. Nichix, you want to know, you want to talk about Met. You got it. It was actually the first stock I was going to talk about. So perfect. I'm on the right stream. You're on the right stream. We're going to talk about MetLife, Snoopy's company. So that'll be the first one out of the gate. You got it. All right. So looks like Sunday night, maybe investors are feeling a little bit like, hey, we've had a couple of nice weeks. January's been a good month. We've made some money. Maybe some investors are taking some money off the table. Let me take a peek at Asia. Asia's already open for Monday. Looks like Japan, their stock market is open and it's down a little bit. And I believe this one's the Chinese. No, this one's the Chinese stock exchange. It's up a little bit, but they just started trading, so this thing can go up or down from this point. We'll see how China goes. I think China has a very good future, but it doesn't mean that stocks are going to be worth a ton. It could, but I think their economy is going to do well. I think Chinese companies are going to do well. Is that going to translate into higher stock prices? I don't know. For the last couple of years, it certainly has not. So we'll see what happens going forward. And Nichix, futures are lower because of the DeepSeek. Trying to figure that out. Trying to figure out your comment. And I'm not getting it, but no worries. Okay, so that's where the markets are at now. It's I think it's going to be a noisy year going forward. And there's going to be plenty of noise. We have a new president that is not shy about, saying his opinion, to say the least. And I think that's going to create some noise. It's going to create some headlines. There'll be other noise factors as well. And my intent as an investor, and I think a lot of the investors that attend my live streams and listen to my videos, I have a long-term, mindset. I want to make money for the next 40 years. I want to figure out how to make money in 2025, but not just there, 2026, 27, 28, 29. And if I find really quality companies, buy them, and at sometimes kind of be patient with them, I'm going to do really well. And that's what I need to focus on. Um, I don't chase stories. I don't buy the rumor, sell the news. I'm not really a trader. I don't like short-term trading because it's too distracting. I've got myself into a couple options. And if anything, it's just to really put a little money down on a long-term trend that I think is going to happen, but it's very, very minimal. Mainly my investments are long term. So as we look at the market, if you're like me, I got to kind of ignore a lot of the noise and just say, you know what? It's going to be a noisy 4 years. Hopefully, it'll be a very productive 4 years. Hopefully, we get to the next, to the end of 4 years. It's like, great, stock market went up a lot. We government did some things that are good for the country. All those things are in order. But my job is to make money on stocks and to get the best companies into my portfolio that are going to make me the most money over the next 40 years, that are going to expand my wealth, just double it every 5 years. That's my job. My job's not a political scientist. It's not a rumor, journalist. Yeah, I'll leave that up to somebody else. If there is a news story that affects one of my companies, I would read it, but I'm not going to be chasing it or really trying to get outside my zone, which is look at a company, believe in their business or not believe in their business, understand their business, then look at their fundamentals. All right. So, Cody Johnson, glad you feel the same way. You're on the right live stream. It's very good to see your name. I think it's the first time you put a comment out there. I appreciate it. We're 8 strong on the live stream. Thanks everybody for joining. I'm going to open up just looking at the market with the take a look at the sectors here just real quick, just to see the scoreboard of so far. We're 3 full weeks into January. It's a good month. Utilities are leading the pack, and they've been doing really well for over a year. Industrials right up there, materials, energy, communication services, financials, healthcare, and technologies down here. Now I think it's healthy to have technology lag a little bit because they've just been killing it for 2 years. So we got to let those stocks kind of rest a little bit, or at least pull some capital from there, or see some capital that's moving from one place to another. So that's interesting that it's all green, by the way, year to date. Consumer staples is in the last spot. So overall, good to see some rotation, see some new sectors that are really performing well. With regards to the mega caps, these have been a great story for the last 2 years, where these mega caps have just created a lot of wealth for investors. And I think it's going to continue. But the one stock that is in correction territory is Apple. And Apple announces this week, and it's a good stock for us to talk about as the announcement is coming, and see what fundamentals I'm seeing and kind of get prepared for the news that's coming, because it's going to be an interesting, out of all the earnings reports this week, this one's the one that can really make the stock move. And I would bet that this stock's potentially going to move down quite a bit, and I'll explain later when we get into the stock. But Apple has been in correction territory, and the other stocks I think are fine. I mean, Nvidia, you're up 6.2% in 3 weeks. Yeah, we're good there. We're good with Microsoft going up 5, and Amazon going up 7, Google up 5.7, Meta's up 10.59. Interesting. Tesla's close to even, and Broadcom's up. TSM is having a great year so far. I think it's the number one year-to-date stock that's listed in the top 13 stocks. So Taiwan Semiconductor came out with a really good report. They are really growing their top line revenue. They have a lot of things working for themselves. So that stock's really working. So that's what's going on with the biggest, most valuable companies. And as we look at the week, it's going to start a little slow tomorrow. The biggest name tomorrow is AT&T. I don't like AT&T stock because they have too much debt on their balance sheet. AT&T and Verizon carry a lot of debt. I have to be careful not to have companies that have too much debt. Debt can really be a prison for a company. They can become a slave to that debt, meaning all they work for is to pay interest. That's a terrible business. So I stay away from AT&T. And nothing's changed from their balance sheet significantly to get me to change that opinion. SoFi is coming out of the gate tomorrow. Now that's a big popular stock, and it's before the market opens, so I'm sure that one's going to get some eyeballs, especially on YouTube. That's a YouTube favorite right there. SoFi. We can take a look at that one in a bit. I'd be curious to see what's going on. Tuesday. Michael Anthony, thanks for joining. Yeah, we were commenting earlier that markets are down for a Monday open. We'll see if they go to the green. But on Tuesday, continuing on the conversation around earnings, we have SAP, which is a big software company out of Germany, and they're going to announce on Tuesday. And that's an interesting company to look at because they sell big business software. And if they announce that, hey, we are doing really well, businesses are spending a lot on CapEx, putting a lot of money back in their businesses, that's a good thing, obviously. I don't think it's a major force in the industry, but it is a pretty big size cap. RTX, which is in a number of aerospace and defense companies are going to announce. RTX is going to announce. Lockheed Martin, Boeing, and I believe there's a couple others that are going to announce that are all in the aerospace and defense industry. So those will tell us, those are usually pretty predictable, right? The government will spend money on defense. That's just an automatic. We have to have a strong military. So I'm expecting that Lockheed will report a good earnings. RTX will report a good earnings. And the whole space should do well. Boeing is a wild card because they're both aerospace and defense, but they're also commercial aircraft where they make planes for the airlines. And Boeing has just been operating poorly. And I would say that is the sick puppy out of the lot. Is, will Boeing fix themselves? Are they showing the results that make investors comfortable, confident that, hey, they're on the right path? And I believe they have a good new CEO that is a manufacturing guy, a good engineer guy. And he actually left a corporate office in Chicago. He said, no, I'm going where the production line is. I want to be close to production line. I want to understand what's going on. It's a really good idea. Good move. I like that move. If the problem is in the production line, if the problem's in quality, don't sit at the corporate office in Chicago. Go to the production lines. Meet with the important people that run those facilities. Talk, understand it. Understand what's being done about it, and try to create good in that situation. Show leadership by supporting the people that are trying to get the problems fixed. And if you feel like as a CEO that the problem isn't being fixed, then you got to make some changes. So it's good to see that out of Boeing, but it's one thing to say what you're going to do. It's another thing to do it. And I think Boeing it's going to take a couple of years to regain the confidence of the marketplace, in my opinion. So that'll be interesting on Tuesday. Wednesday, that's when it really gets serious. All right. We've got some massive caps announcing. Microsoft, Meta, Tesla, ASML, ServiceNow. We got some biggies. Lamb Research. So Wednesday is going to be there's going to be a lot of news because the way Microsoft reports, it tells us a lot about the technology spend, how their cloud business is expanding and is the rest of the space going to be doing well. So they can really move the whole market. Meta's been super active and I expect them to report good numbers, but more importantly, they've been very active politically. Tesla has been super active politically, and their numbers, it's almost like the fundamentals for Tesla don't matter. It's what, Elon Musk is such a rock star. He could just say some really cool things and the stock's going to rally. So we'll see. We'll see how Tesla announces. I really look forward to seeing ASML's numbers as well as Lamb Research. If these two pretty much support what TSM came out with earlier in January, semiconductors are going to rally. The rally's going to continue. So we'll see how those things play out. Thursday, Apple. This stock, I don't know how they're going to pull a rabbit out of a hat, but their revenue's not growing. The revenue's flat. And they may have a story as to how they're going to grow, but they don't have any new innovative product. And I think the iPhone is getting pretty tired. It's a product that's been around for a long time. We don't need 5 iPhones each. We just need one. And my phone works just fine. I have no necessity to go trade up. I don't know how other people feel, but just Apple's not an exciting business right now. And I think coming up to their earnings, I just don't see where they're going to pull a really exciting story. When you look at their main rivals, Microsoft, they can talk about OpenAI and ChatGPT and really catch the market's attention and show excitement there. They're in OpenAI. They're a major investor. They're using AI in their product as a co-pilot. Now, it hasn't been a huge success, but they're trying, and it really creates a more exciting company. So I think Microsoft, in my opinion, is far better run, which is why I'm buying the stock. Meta's super exciting right now. Meta has done a lot of the right things for 2 years, and their stock is just flourishing. So those two companies have momentum. Apple has lost momentum. The great Warren Buffett is selling their stock, selling more of it. Nancy Pelosi sold Apple stock. So everybody, I mean, these big names are selling Apple. So ahead of the earnings. So we'll see what happens on Thursday. But that one there, again, we gotta, get our coffee makers ready or energy drinks chilled. And because Wednesday, Thursday are going to be huge. And we're going to be very technology focused, on Wednesday and Thursday. But right after, Apple is Visa, MasterCard, Blackstone, just really good financials companies, especially Visa. And Visa will tell us a little bit about the economy. We have an economy where 70% of the economy is represented in the consumer, depending on how much the consumer is spending. So Visa's announcement is going to tell us a little bit of, hey, the consumer spending money, or they're not spending money, or it's similar to last year. We'll see what Visa says as well as MasterCard. And those are the big names in Thursday. And then Friday, oil. Exxon, Chevron, as well as others will announce, like Phillips 66, Imperial Oil. They will announce on Friday. And that's usually when they do it. For some reason, Exxon and Chevron like announcing on a Friday before the market opens. Now, oil was doing better. It was like in the high 70s for a little bit. And now it's coming down to the low 70s. So I think the market's been, the slowing down the price appreciation for Chevron and Exxon, but they are going to be very profitable, and they're going to show that. Now, what could be a big positive for oil in 2025, 6, 7, and 8 is you have an administration that's going to reduce the burden of regulation on these companies. And if they do that and oil companies become more profitable, their top line may not expand very quickly, but their profitability is going to explode. Their free cash flow is going to explode. And when that happens, I think their valuations are going to go up. We'll see. I think it's going to take a little time. And I'll show you Chevron stock on this live stream, and I'll show you that Chevron stock is discounted. So is Exxon. And you're not, in my opinion, I'm not taking a big risk on Chevron because it can't go any lower. It might go a little bit lower, but not a whole lot, but it can go a lot higher. So we can take a look. So Michael Anthony, MFA looks like it's making higher highs. All right, cool. Yeah, we can take a peek at MFA. Got a list of stocks I'm going to go through, but I'll get to that one. All right, so those are the earnings that are coming up. Now, it's already been requested. I think Nichix requested it, but this one, MetLife came up last week on Thursday. And as I mentioned, I like MetLife as a business. They make a lot of money. It's an insurance company. They're very well known for life insurance. And when we look at these businesses, they tend to be boring, but they tend to make a lot of money. So over time, they are a positive stock to have. It's in this case here, MetLife is up 66%. And if I add a 2.5% dividend, I compound that dividend, we're probably adding 15% on top of 66, making it probably closer to 80% return. That's very good from a well-respected company. I'll take that any day of the week because I have some really exciting stocks. But some of those exciting stocks, they go up really fast and they fall really fast at times. So, but these like MetLife, this is like a blue chip stock, very reliable, more Dow based. So it's not a bad stock to consider because we've been in such a, bull market for 2 years. Is it going to continue? Maybe, but a quick reminder that, going into 2023, we were expecting a recession. It never came. So the market really rallied because it was like a surprise. Oh man, we're not going to have a recession. We're not going to have, just no GDP growth. Okay, cool. Stocks rallied. So then going into 2024, the Fed was supposed to cut rates very aggressively because inflation was being tamed. Interest rates were quite high. There was a concern that, hey, they're going to slow down the economy into recession. Well, the rate cuts didn't happen, not 7 of them, which were the estimation at the very beginning of 2024. That surprise caused the market to rally. Now we're going into 2025 with an optimistic point of view where GDP growth is supposed to be 2.4% or something. There's a pretty good probability that there is negative surprises in 2025. So we can have a sell-off in 2025 that could be a good one. And owning a stock like MetLife might look like a really good move before we have the sell-off. Because in times like that, MetLife will have policies with its customers, and they'll have a relationship with that customer for 50 years. And that customer will pay their premiums so they can have their life insurance so that, if they pass away, their families are taken care of. And, why we buy life insurance or whatever types of life insurance MetLife is selling. They also do dental insurance and a variety of products. They also sell annuities. So all those things work in a bad economy. And MetLife tends to hold its value when the markets go into the into bear markets. So it's a good idea right now to look at MetLife for me and think about, okay, well, this one here might be a good safe stock to buy into, but let me value it. See, is it a stock worth having? So let's take a look at it. So first thing that I like is it has a super low PE, 9.36. That's really low. Dividend 2.56, pretty decent dividend. Analysts believe it's a strong buy and it's discounted by 5%. Now, when we look at their revenue, they have revenue growth. It's a little bit cyclical. You have some ups and downs, but they do have revenue growth. When we look at the quarterly, especially, man, look at that, 16%. This is a pretty big company, right? 18 billion in revenue. So that looks really good. I like what I'm seeing there. Good revenue growth means the business is healthy. It's adding customers. It's getting new customers. The customers that already buy their annuities and stuff are buying more. And look at their cash flow. Beautiful growth in cash flow from 2020 to 2023 and into the trailing 12 months. Just nice upward slope. Beautiful data. I love upward sloping data like this because it makes me feel confident that I'm going to be able to forecast their free cash flow accurately. So I really like their PE. I really like their free cash flow. They're growing their top line revenue. Their margin on cash flow, 21%. Not a lot of businesses are going to look like this. To have a margin of 21% shows that for every $100 of revenue, you get to keep $21 of cash. Very, very strong metric. All right, we looked at that. Let's look at the forecast that analysts have out there. Now, the best case scenario, you're not going to hit a home run. It's not going to be a multi-bagger overnight. $99, just going to go up a little bit. Worst case scenario, not too bad. Nice safe stock. Look at that. That's why we get an average price discount of 5%. Is 13 analysts are putting their price targets out there, and so it's a stock that they believe in, and it's pretty predictable. When we look at their earnings per share, revenue is going to continue to grow nicely. Okay, good. Single digit, mid-single digits. But their earnings per share growth is really going to expand in 2025. It's a really nice expansion of 17%. So very good. And that's what's going to drive down that forward PE. So that looks excellent to me. So Met is looking good. Now let me put all those metrics into my evaluation. And my evaluation is I took all the free cash flow that we have. I put together a free cash flow forecast that includes the first 4 years and then a terminal value, all cash flows after year 4. And the cash is so darn high, it creates a huge number. And it creates a very large intrinsic value number. I add cash and take away debt. I get this massive equity value. Again, they have such a high free cash flow margin. To me, they're very attractive. It's highly discounted. You can do a lot of things with cash. There's no secret that Warren Buffett likes insurance companies because they create all this cash, and then he likes them to begin with because they produce that cash. But companies like Met can buy into investments. Right now, bonds are doing really well. They can make a lot of money on bonds, treasuries, that kind of thing. And there's a lot of ways for Met to make money. And when I value the company based on earnings per share, using very low metrics like a PE of 12, a growth rate of 5, I get the stocks discounted by 44%. So overall, Met is a buy for me. I'm going to start buying the stock just because I've owned Met in the past. It's been a long time. And I just think the numbers are just too good. And it is an industry that I've made plenty of money in 2024. But it's not an industry or a sector like technology that's so high. Like, it's really hard to buy Nvidia stock, in my opinion, because it's so high. I don't think financial services has gotten that crazy, and especially companies like Met. They have really good fundamentals. So I'm going to be buying into Met and see how that goes. I think it'll be a good addition to my portfolio. And then I think that answers the question that Nitchix had. And Nitchix is, yeah, you're commenting. Met has a free cash flow yield of 25%! Exclamation point. I completely agree with your sentiment, and I completely agree that, you know, that's just a really strong business. You look at how they've done for 5 years, right? Nice, consistent upward chart. They've had some pullbacks. It's just going to keep going up and to the right, in my opinion, because their fundamentals are so damn good. Their cash generation is phenomenal, and so I'm good. Let's look at their dividends and just kind of show one more thing. They're paying out 44% of their dividend, of their profitability. That's really good. And their buybacks, 6.67. It's really good. The shareholder yield measured by buybacks plus dividends, 9.23%. That's ridiculously good. That's very good. So, all right, Snoopy, your company's looking good, buddy. I'm a Snoopy fan. I like Snoopy. I don't think a lot of people dislike Snoopy. Snoopy's a good, favorable icon. Even though sometimes, you know, Snoopy, he kind of misbehaves a little bit, pulls a couple stunts. Sometimes he's not the most, I would say sometimes he's a little bit sneaky. But for the most part, Snoopy is loved. And I'm right there with everybody. All right, so that's MetLife. Thanks for asking about it. Let's move on. All news. Hey, I think it's your first time commenting. Appreciate it. You want to look at SHW. Is that Schwab? Let me get some water here. I think that's Schwab, and I'd be happy to take a look at that. Just understand there's a couple people ahead, so I'm going to keep rolling. I'll get to SHW in a bit. I'm going to start with MFA. So MFA Financial, together with its subs, operates a real estate investment trust in the United States. It invests in residential mortgage securities, including non-agency mortgage-backed securities, agency MBS, credit risk transfer securities, residential whole loans. Okay. Small cap, 1 billion. Super low forward PE. Very high dividend. Analysts believe it's discounted by 32%. Wow. Now, super high dividend, and the stock has not been appreciating. So this one here, you know, out of the gate, I feel like it's risky because the fundamentals are so outrageously good. Dividend is so high. Usually really high dividends, there's like very quickly my spidey senses start to tingle. They're like, okay, why is this like this way? You know, dividends shouldn't be that high. At that rate, they're paying out 87%. That isn't a showstopper, because if it's a real estate investment trust, they have to pay out most of their funds from operations, FFO. So that's normal. That doesn't, you know, create any red flags for me. But what does create a lot of red flags is, why is the stock down 67%? You know, one can argue, well, you're still ahead of the game if you're getting paid a 13% dividend over 5 years. What is that, about 55%, but you're still underwater. So, yeah, I don't like that. I'd rather buy a strong business. I don't want to chase kind of like, I'm going to get a 13% dividend. I'm going to have to pay taxes on it, which isn't good. But let's keep going on. Maybe I'm not giving this thing a fair look. So let's keep going. So financially, these guys are doing mortgage-backed REIT, and it's not giving me revenue growth, but the revenue, it looks like they had a negative year in 2020 because we had COVID. And it looks like they had a lot of losses. Okay. But then they had a negative year in 2022. What may have happened in 2022 is we had a severe rise in interest rates. And if you're holding a bond, or in this case here, a loan, and that loan maybe was at 3.5% or 4%, and all of a sudden interest rates jump up and now loans are being signed at 7%. The value of a 4% loan went way down because nobody's going to want to buy that from you. They're going to be like, no, I'd rather buy a loan where I receive 7% interest on that loan. If you sold me that 4% loan, you'd have to discount that loan, sell it to me at a fraction of its face value in order for me to take it. And the combined yield of the difference between the redeemed amount and what I get, that difference makes up for the lower interest rate. And that's what happened probably in 2022. And the higher interest rates are what's probably making this stock go down in value. That it's probably putting the mortgage industry at more risk. So I'm seeing that, again, this is from my point of view, this is risky. And this is also a business that's not easy to understand. Okay. It's not easy to understand for me. Maybe it is for you. If you understand it really well, man, you might have an advantage in this stock, be able to make some money on it or avoid a big loss. For me, I'm seeing risk. And cash flow is decent. But this one here, it's a pass because I'm just seeing too many like unusual metrics. Really high dividend. Okay, companies shouldn't pay dividends this high. Something's wrong. Well, it's because the stock prices drop so much that it makes that dividend really outrageous. Okay, well, the stock dropped for a reason. Why did it drop? Well, there's probably interest rate dynamics in there that are really hurting the company. We saw Silicon Valley Bank go bankrupt, or there was a run on that bank in 2023. Stuff like that can happen. And I'm not saying it's going to happen to MFA. I'm not saying it's the situation they're in. I'm just saying there's too much risk for me to go into this business. I'm not going to understand it well enough to see that, hey, no, actually, this is a great opportunity, or it's not. If you showed me a software company or you showed me a different type of business, I might be able to like navigate their financials and say, hey, this is actually a really good opportunity that I want to take advantage of. That's not the case with MFA. So that'll be my comments on MFA. Michael Anthony, looks like you had a comment on it. Let's read your comment. So they're making higher highs over the last month or so. I'm not seeing a long-term trend yet, though. The long-term trend's really bad. I mean, just not so long ago, September of 24, they were at $13 per share. So I'm not sure I'm following your comment, but we looked at it and that, provided my comment. I don't think you can argue that I'm not the only one looking at it going, hey, there might be some trouble with this stock. So they're staying away from it. All right. Thanks for asking. Michael Anthony, China data or PMI was 49.1, was under 50. What does that mean? Can you add another comment, please? Like, what does that mean? Is that good? China is going to flourish, or it's bad? China is not struggling. While you do that, let me go over SHW. Oh no, that's Sherwin Williams. This is a materials company. They do paints, coatings, and related products. $90 billion market cap. Stocks worked for 5 years because you got 81% appreciation. Got a small dividend, maybe adding 5% on top of that. So in general, I think this one's worked for investors. Over the past year, it's gone up 17.9, pretty much doubling down on the comment I just made. These are really well-known businesses that are stable. They've been around, these guys have been around for more than 100 years. The revenue is $23 billion. Okay. PE is a little high, 29.45 in the forward PE. They're not growing very much, 0.10%. Yeah, the growth concerns me. This is going to be kind of a slow grower. And we're going to begin to deal with some things that, you know, the new president is using tariffs as pretty much a regular tool. Like he's going to be adding tariffs here, adding tariffs there. Now, Sherwin Williams, I'm sure, is importing a lot of their ingredients, materials that they need to. They might even be importing like paints and so forth that they then they get them in big containers, put them on big rail cars, and then they put them into the production lines and make paint cans and so forth. Now, if some of the tariffs affect their supply chain, that could be a real negative. If they're in a bad economy for like construction and so forth, which I don't think it's thriving. I think it's doing okay, but it's not thriving. Then those tariffs may squeeze their margins. It may not, but I see that might be a problem. Okay. Gross profit looks good. It's like 50% gross profits. I think it'll give me the percentage down here. So gross margin, 49%. Very good. For a materials company, it's excellent. So very good. Free cash flow has been a little inconsistent. We've had $1 billion, and I'm looking at the quarterly. So let me get out of the quarterly. So free cash flow, $2 billion, 2.6. Yeah, it's been a little inconsistent, like $3 billion in 2020, 1.8, 1.2, 2.6, $2 billion. Yeah, it'd be nice to see them. I think I showed a stock, I think it was MetLife. You saw that smooth upward chart. That makes me feel comfortable and confident that, hey, I could probably expect where free cash flow is going to land for 2025, 26, 27. This one here, it's a little bit too random, not very consistent. And if we chart it, it's not a smooth chart. It's kind of an ugly looking chart. All right, so that's 2 billion. So analyst, looks like 15 analysts cover the stock. Worst case scenario is it's fairly priced. Best case scenario, it's going to go up nicely. So it's discounted by 12.47 on average. If you take all their price targets and average them out, it's discounted. And they're expecting revenue growth in 2025 of almost 4%, and then almost 5%, and then 5% in 27. So the PE is going to come down a little bit. I don't like this PE. The reason for it is this is materials, and they have a higher PE than the S&P. The S&P has some pretty exciting businesses in it, so I'm not in love with that PE. I'm not in love with their cash flow. Cash flow is really low. At $2 billion, I can't get to this valuation. This is a slow growth, no growth company. If they have $2 billion in free cash flow and I multiplied it times 15, I'd get to 30 billion. That would be my rough market value of this company, which is well short of their market cap. The earnings per share might get us near this number, but it's still at a really high PE. A materials company, at best, I'd probably have a PE of 18. And that's a company that's showing like single digit growth, like 5%. Sherwin-Williams does not have that much growth. It's like almost zero. So this was a solid pass for me. They just don't have, they're not showing that they're going to be worth a lot more in the future. In fact, I wouldn't be surprised if this one has a lot of trouble in the next 2 years. I'm trying to look at their balance sheet, see if they have any debt. Yeah, they have about $12 billion of debt. And they have about $238 million cash. That's another factor that kind of goes against their valuation. They're not producing a ton of cash. I think based on the free cash flow, discounted free cash flow model that I would put together for these guys, I'm going to fall way short of this valuation. I'm not going to get to $90 billion of value for this company, especially when I have to deduct nearly $12 billion of cash from that value. So this one's a solid pass for me. I wouldn't be interested in analyzing the company. I wouldn't be interested in buying it. But that's just my comments. I never provide advice for you to buy, hold, or sell. I'm just sharing what I would do and how I see it. Hopefully you found the comments interesting. So that's my comment on news. Good luck with that. All right. So Brian McLovin, good to see you again. GPN. This is Global Payments. So this stock's been beat up. So Global Payments competes against PayPal, and this is a little bit of a crowded market. Global Payments provides payment technology software solutions for card, check, digital-based payments in the Americas, Europe, and Asia Pacific. Okay. All right. And not a bad market cap, 27.75 billion. The stock is sold off over the 5-year. Over the 1 year, it's sold off. And PayPal also sold off, but PayPal has rallied more recently. Revenue's $10 billion. Very low PE going forward. Interesting. Analysts think it's discounted by 24%. They are growing. So their growth is 5.8%. In the trailing 12 months, and the last quarter was 5%. That's good growth. It's not like, wow, NVIDIA impressive kind of growth. No, but it's good growth. It's a pretty big company at 10 billion. They're growing at almost 6% growth. That's very good. Okay, looks good. Free cash flow in general has been expanding. The 2888 looks good to me. Okay. It's going to be important for them to stick to that number. Don't go 288 and then next year go down to 1.5 or billion. So looking at the quarterly, had a very good Q3. All right. Looks like they're expanding their free cash flow. And when do they announce? They announce on February 12th. So they announced their last earnings around here, and the stock really moved. That free cash flow number should have made this number move. And then it came back down. That free cash flow number was pretty impressive. So we went over free cash flow. And analysts believe 21 cover it. Worst case scenario, you lose a little money. On average, you're going to make 24%. And one analyst really believes in the company, $194 $1 price target. Real nice. So this one here, revenue is going to keep growing and single digit looks good. Earnings per share are going to expand. They're going to expand their profitability faster than their revenue growth. Very good, which is going to drop their PE even further. Wow. One thing I didn't check were their margins. Everything so far looks good. So gross margin looks really good. So this company is discounted. And I would say I could value this company at 50 billion. Let me look at their balance sheet just to make sure. They don't have a ton of debt. Okay, they do have some debt. 3 billion of debt, 3 billion of cash, 17.5 of debt. So they have about $14.5 billion of debt. That is pretty good little debt load. EBITDA is 4.36. So they have over 3 times EBITDA of debt. Debt to EBITDA is almost 4. That is a red flag. Why do they carry so much debt if they're creating so much cash? They should pay off some of that debt for sure. Now, the payment market is a little bit of a crowded space. Right now I'm in PayPal, and I'm in deep with PayPal. It's going well. And this one here does look interesting. Looks like it might be discounted, and they haven't caught like a really great rally. Maybe investors are worried about that balance sheet. But if you compare this guy, let's compare it over to PayPal. PayPal is more diversified, but they do a lot of the things these guys are doing. And there's some other companies that compete with these guys. But if we look at the 1 year, see, PayPal is, they both were like, for some reason, payment companies were kind of beat up in 23, and they took them a while in 24 to really start moving, at least for PayPal. But then PayPal moved. PayPal's up 44% the last 12 months. So PayPal started to work. And I'd rather stick to PayPal because global payments might be a little bit too old school to be a great company. This is what I mean. PayPal owns like Venmo. They're already into crypto. They created their own crypto coin. And all those things are about the future. All those things are about like, hey, getting more customers, getting them excited about, the products that you have. And I don't think global payments has that type of newness to them, new and exciting products. So they're going to be battling for the old school payment services, credit card processing, and so forth. And when you have more competitors, everybody starts undercutting each other, and it gets really hard. It gets hard to grow. So that's why maybe global payments is sold off, not really rallying. I don't know if the story is different or could change for the better, but I would really study the story of global payments. Come to the conclusion, do you think they're going to be bigger in 5 years? Like, hey, they're going to grow at 5-10% and be a bigger company? Are they going to be a player? Are they going to be a strong, powerful player in their space, in their little industry? The answer is yes. I would okay. I'd be in the mood to invest. But if the answer is no, it's going to be questionable if they're going to be able to compete. Then I would probably pass because I'm in PayPal. I'm in New Holding, excuse me. Those are the two investments I'm in right now that resemble global payments. So those are my comments there. Good luck with it. Thanks for asking, Brian. Too Real Neil. What's up, man? Good to see you on the live stream. I don't think you've asked. I don't think you've attended before. At least put a comment out there. Appreciate you attending. All right. This little company that's now the most valuable company on the stock exchange, NVIDIA. So what's interesting about NVIDIA is from this point, June 18th to now, it's up 5%. So and when we get to June 18th of 2025, if they don't go up, this is not going to be like a super exciting, sexy stock anymore. Over the last 12 months, over the last year, excuse me, 1.33, right? And it's like, whoa, well, that's not exciting. There's some stocks that are up like 300%, like Palantir and Robinhood. I mean, those stocks are just crushing their 12-month. So what's going to happen? I mean, NVIDIA is massive, right? It's a 3.5 trillion valuation company. So it's hard for them to go up, because if they go up 10% in value, that's $350 billion in market cap. Investors have to pull $350 billion from other stocks or bonds or cash to buy 10%, to bid up 10% NVIDIA stock. So it's just a lot of gravity. So I think very highly of the NVIDIA business. It's a great business. I just think it's overvalued. I'm going to cut through the chase. The company is going to have to be incredible for the next 10 years to keep its valuation. Now, I think they're incredible now. I just doubt they're going to be incredible for 10 years. It's really difficult to be incredible for a couple years. It's almost impossible to be incredible for 10 years. I think they're overpriced by 41%. And, I've covered NVIDIA closely for 2 years, and I've been surprised by it. I've been surprised by their stock price. From a position of being humble, the market has really been excited about the NVIDIA stock. I haven't, and I've been wrong. But I'm going to stick to my analysis and just say I think the stock's too expensive. And I started saying that a year ago. I started talking about shorting the stock, and you can go to my channel and see when I did the videos about here. And since then, again, not too long after that, the stock really hasn't done anything. So it wasn't like I was like completely imagining fundamentals that didn't match a company that was super, super exciting. Or I should say that supported a stock price at their level. I think the market as a whole is like saying, wait a second, this stock's really expensive. So I think it's overpriced, and it's interesting to see that NVIDIA is where it's at. Looks like CSA, SAC, you would load up at 125. Cool. Good luck. I hope you double your money fast, man. I hope everybody makes money, but the reality is, NVIDIA, this is going to be super interesting how it plays out. The other thing too is like NVIDIA doesn't announce their earnings for like another month or so, maybe a month and a half. So they're really late in the earnings calendar. So we don't get data from them for a little while, but we're going to get data from some of their biggest customers. Like Microsoft's going to announce on Wednesday that they're a big customer, and they might say something that makes the NVIDIA stock move, but we will see. The pre-market's down 0.42%. And man, I love investing in stocks because I get to, see how NVIDIA stock moves, if it's going to move up or down long term, and either get to make some money or lose some money. In general, I made a lot of money in 24. I'm up in January. So, but in the process of making money long term on stocks, you get to witness some of these stories like NVIDIA and just be present and look at them and go, wow, that was incredible, man. It's incredible what they've done. And just to let you know, like, I bought 2 NVIDIA GPUs for my son who wanted to mine Bitcoin about 8 years ago. So I'm not a stranger to NVIDIA. I know NVIDIA. I know their story. I know their stock. They were primarily a graphics processor a long time ago for video gamers. Then their technology was excellent for accelerated computing, high performance computing, and that was really, really good for building large language models for AI. It's very good for AI. That's great. So their technology is gonna be great. But one thing that I would like kind of again, I have very high respect for NVIDIA, very high respect for the CEO. But let me just kind of rephrase something that's important. NVIDIA started off as a graphics processor for video gaming primarily. That's where the CEO, created this technology. They're trying to make the experience of video gamers far better. Fast forward, the CEO is now talking about how he could see the future around AI. Oh yeah, AI is going to do drug discovery. And it's going to do this. It's going to do that. It's like, wait. You're the same CEO that was excited 10 years ago about video games. And that was your world, was video games. Now you're telling us the future of like drug discovery and how robots, everybody's going to have a robot and all this stuff. So he's got the stage, or I should say the attention of the world, the market. But I think it's a little, it's AI is in its infancy. It's very new. It's exciting. It might be something really cool in 5 to 10 to 20 years. It's not going to be that in the next 5 months. That's my expectation. And I don't think I'm going to be far off from that. It's going to take years. So when somebody's saying, "Oh yeah, this is going to happen and that's going to happen," I'm like, well, I don't want to get too carried away with that. But let's see how it goes. Thanks for asking about NVIDIA, an awesome company. So Brian, so you wanted to? I'll take a look at MPWR. What is that? Monolithic Power. Wow, they really came down, huh? So Monolithic Power engages in the design, development, marketing, and sale of semiconductor-based power electronic solutions for storage and computing, automotive, enterprise data, consumer communications, industrial markets. The market provides direct current. Okay. So they're in semiconductors. And DC meaning they're portable, they're in cars and so forth. Okay. They've had a big pullback. They went from $933 a share down to $600. Man, that was a pretty good haircut. 33 billion revenue. So I didn't see anywhere. So when you say automotive, okay, that's not exciting. Enterprise data, not sure what they mean. Consumer communications. Yeah, consumer and then communications, right? That's kind of portable. Okay. So it's not in the data center. That's important to note because everything in this data center is just, going crazy. And this one's kind of gone crazy. It's up 270. So it may have written up with the semiconductor space, but what's super red hot is semiconductors for the data center. That's what is super red hot. This one here is forward P is 42. Let's take a look at their revenue. Now they grew 270. They appreciated by 270% over 5 years. I'm expecting really good growth. Growth is good. Yeah. So Growth in 21 and 22 was excellent. It slowed down in 23. They had a bad run of 3 quarters in the negative, slow growth, and now they're beginning to grow again. Very good. Okay. Let's take a look at their margins and free cash flow. So the margins are 55%. That's good. Free cash flow of 678. So they're growing really nicely. I would probably, assuming their balance sheet isn't loaded up with debt. Nope. They really don't have any debt. They have $1.46 billion of cash and almost no debt. Yeah, I would say that these guys are fairly priced or maybe priced at a little bit of a premium. If I took their 688 times 3, that would put me at times 30, excuse me. That would put me at like 20 billion. Yeah, these guys are still priced quite high. You saw that they had a problem growing, and that can come back. I mean, you see that the stock price just really tanked. So this one would be a pass for me. Right now, semiconductors are really priced high, and there's going to be a correction in this space. Not all semiconductors are super valuable right now. There's the ones that are in this data center that are really important for AI. Yeah, those are really important. But you're sticking these in cars. The car business is struggling. It's not doing all that great. You're putting them in storage. Storage is a commodity. Communications. Okay, I'm not sure what they mean there. Industrial markets. Okay, so this is not an exciting part of semiconductor from my observation. So this one here would be a pass. I think it's pretty risky. Needless to say, when it dropped off like 35% very quickly. So, yeah, those are my comments on that one. All right, guys, we're 19 strong on the stream. We've been going for a little over an hour. All right, so we are expecting earnings from SoFi, AT&T, Microsoft, Meta, Lam Research, Apple, Chevron. Really, really big week this week. So it should be pretty interesting to see. Let's take a look at Apple. So this stock here, again, if we see a week where this stock goes down 20%, this could be the week. So if Apple comes in with, hey, our revenue went down 5% and we don't have a really good story to make investors feel like Apple's going to grow in the future, I think this stock could really sell off, and it'll be an interesting day. They have a forward P of 30. And in my mind, forward P of 30 means you're growing, means you're becoming bigger. And when we look at their financials, this is what's been like amazing to me. In 2023, their revenue contracted and their stock kept going up. It kept going up. Then the following year, they grew by 2%. That's like terrible. Stock kept going up. It's like, what am I missing here? That's not exciting growth. For a long time, they were the most valuable company on the exchange, and they're growing at 2%. And you might say, oh, they're really big. Okay, well, let's look at another big company that I think is the best comparison to Apple based on size and the power in the industry. Microsoft, they're worth $3.3 trillion. How are they growing? 16%, 15%, 18%, 17.5%. I mean, this is growth, okay, on big numbers. Apple's like, guys, More importantly, you think about, okay, Apple, what's the next product that's going to be like everybody has to have it, and you're going to add $100 billion of revenue on your income statement? Nothing. They have no product that fits that description. Where Microsoft has the cloud that's growing really fast, the public cloud. They have ChatGPT, OpenAI. They own a big portion of that company. Have, you know, not control over it, but strong influence. And they could probably acquire it at some point. Or if anything, if OpenAI goes public, Microsoft's going to own so many of the shares that in itself is going to be worth a lot to Microsoft. So again, back to Apple, they don't have any of that. They have none. They tried to make a car. What a bad idea. Their founder, Steve Jobs, has passed away. He was the kind of like the wizard that made things work. They have no wizard anymore. They have a very professional CEO, but he has no vision in technology. He just knows how to operate a business. And I think if you're in technology, you have to be just incredibly creative from a technology perspective. You have to be able to grow your company, make them, you get to a certain level of success and keep making the company even better. Microsoft's done that. It's been really impressive. Google's done that. Super impressive. Amazon, super impressive. So, man, this one's going to be interesting, guys. I got my popcorn. It's going to be ready. And man, you don't have to pay me to, listen to the Apple earnings and see what's going to happen here, because this is going to be the big one. We'll see where it goes. Over 5 years, this thing's delivered to stockholders. But Warren Buffett and others are selling off. They're getting out of Apple. They're like, oh, man. So this thing can really settle down. I mean, not too long ago, it was down here at $165 per share. I think it could get down there really fast. And we'll see. We'll see if that happens. But right now, it's a correction. It's sold off in 2025. It's already sold off more than 10%, the stock price. And I think it's kind of exhibiting like, hey, there's some investors out there that are nervous. And more than 10%, right? There was a $3.5 trillion. It's actually got up to like $3.8 trillion. So that 10% is like close to $400 billion of capital leaving the Apple stock and going elsewhere, going to cash, going to another stock, going somewhere else. So Apple is, that stock, I'm a fan of Apple. It's incredible what they did, but I would just say, look, you need to, companies, if they want to be really valuable, you have to keep making yourself more valuable. Apple didn't do that. They actually rested on their laurels, continue to milk that ecosystem around the iPhone. But guess what? Around the world, it's not working. Apple phones are not selling as well in Asia. They have a big competitor out there, Huawei, and they sell phones for a fifth the price of Apple, and they can do just about everything an Apple iPhone can do. So consumers in Asia are buying the Huawei, or they're buying another brand. Samsung is a big competitor. So all those things, I think, when you add them all up, it's big concerns around Apple. And we will see how it plays out. I'll give you my valuation on Apple. I have it. I think it's priced too high by 17%. And I'm being very generous on every metric. In fact, interest rates are higher, so you can probably move that to 8. It's probably priced at a premium of 23%. And I think it could settle down. I mean, if it starts selling off, it could sell off, 20% very quickly. And we'll see what happens. That'll be the one that I am really looking forward to. And I'm looking forward to Microsoft. Microsoft, I think, is doing a lot of things right. Their cloud is growing great. They're growing their top line revenue. Their PE is lower than Apple's. They're growing at 16%. Apple's pretty much not growing. and Apple's PE is higher than Microsoft's. Microsoft's at 33.8. I've been buying into Microsoft because to me it was surprising that the stock was only up 10% or so. And I started buying in this neighborhood right here. Glad I did so. And I continue to buy shares because I still think Microsoft is really a strong company with a very strong future. Like the next 10 years, their cloud business is really strong. Their software business really strong. So Microsoft is the horse of between the two, Apple and Microsoft. It's the horse that I'd rather ride. And by the way, I own Meta, I own Google Alphabet, I own Amazon. Those are awesome companies too. But Microsoft, I thought, provided a really nice little opportunity. You see these low points here. It's like, this is Microsoft, people. Like, are these investors kind of like not understanding what the heck they're doing? But the market really caught on. Year to date, stock's up 5%. You can see that, hey, not too long ago, man, you could have picked up some shares at a nice price. You're not going to get Apple at a crazy discount. Analysts think it's discounted by 15%. I think Microsoft is just discounted by 8%. So I'm not as optimistic as analysts. Analysts just use earnings per share. I use earnings, free cash flow as the primary valuation of a stock. And then I look at earnings per share as only 1/3 of what I think. So in general, I'll buy Microsoft at fair price right now. I think they're really good and it's going to work for the next 10 years. So Microsoft's going to announce on Wednesday. It'll be watched by the world of stock investing. They're going to announce on the same day as Meta and Tesla. So it's going to be like overload. It's going to be like, man, we're going to need more power for the internet to handle all the volume of interest. But that one there, it's going to happen. I think it's going to happen after hours. Meta, Microsoft, Tesla will be after hours. So after hours on Wednesday will be super interesting. I'll make sure to stream Wednesday, probably 5 p.m. Pacific, 8 p.m. Eastern. And make sure we cover it because it's going to be a really interesting time. I'm going to stream on Wednesday and Thursday for sure this week, unless something comes up. But it's going to be really, really, really interesting, man. All right. So we got some new names on the board. Omar, what's up, man? You're a regular and I appreciate you attending regularly. Where am I putting money in this crazy market? So let's talk about that. So, now, for some reason, my Google app is not responding to me. Now it is. Okay, cool. So a lot of my money's already in on stocks. These are companies that I believe in really long term. Companies like Meta. I mean, I've owned Meta for a long time. I really believe in Robinhood. It's been just screaming up. Awesome. Google Alphabet, I'm a big believer, and my money's already in. It's not going to go anywhere. Am I adding more shares? No, because I have so much of it. Where I'm adding, so what to answer your question, like Meta is my number one position. So I manage one of my sons, he has a portfolio and I manage it. Meta's in his portfolio. And I have money in Google Alphabet, a lot of it, and I'm going to keep it there. I'm putting money into Microsoft because I don't own a lot of Microsoft. So don't let it, don't misunderstand me and say, oh, well, Microsoft is number one stock, period. No. I love Meta. I love Google Alphabet. I love Robinhood. It's been screaming. And I think I got the story right on that one. I like Coinbase a lot. I like Bitcoin a lot. It's been doing great. I've been invested in Bitcoin since 2018. I'm glad I did so. I think Pfizer is going to surprise to the upside this year. I put money into Pfizer. PayPal started to come back for me. I put a lot of money into PayPal, and it's been doing well. What are the stocks that I got out of because I just thought they were just terrible decisions that I made? Nvidia. I'm sorry. Intel. Man, I was so mad at the CEO because he did not communicate to the stockholders. The CEOs and the officers of a company, they work for the stockholders, and if they don't communicate accurately, regularly, and just surprises, it's very upsetting. I worked really hard for my money, and then I invested, and I spent a lot of time analyzing companies and making the right decisions. So Intel surprising the investing community and tanking the way they did, it's like so screwed up and upsetting. So Intel is probably the worst stock that I owned in the last 12 months. What's another stock that I thought, man, that was a bad idea? I think Intel kind of takes the cake on that one. A stock that I sold recently 6 months ago, Zim, shipping freight. I got it right. I made 50% in short term. Got out. I don't think it's done much higher or much lower since I got out. That one does get pretty damn risky. You got ocean freight. So CBS, I'm glad you brought that up. CBS, I've had wrong for a year and a half, 2 years, and now it's beginning to prove me right. It's up like more than 20%. I think the healthcare space has just been a complete surprise for me. Some of these healthcare companies make a lot of money, a lot of cash. So the market's been selling off like Elevance and CBS, Cigna. But I think they're going to really do well in 2025. They're beginning to really work. We'll see. I could be wrong again one more year, but I'll tell you all the things that have worked for me, and I'm going to try to be honest with this community. Any investor out there that just talks about good, is probably just hiding the stuff that they don't want you to hear. I'll tell you the mistakes that I made, and I'll tell you the stocks where I lost money, and maybe you saw that stock and you avoided it, or maybe you invested in it and it also kind of stung when you lost a little bit of money on it. I've been wrong on some short selling, and I've been right on some short selling. I was right on CrowdStrike. I was right on Super Microcomputer. I was wrong on, so far I'm wrong on Nvidia. Nvidia has been a superb stock. I started shorting it middle of 2024. I think I've lost like 15%, 20%. I didn't put a lot of money, but that's what happened there. All right. So it looks like on Shul, make sure I'm picking up on the comments correctly. So that was Omar. Omar, you asked me kind of an open-ended question, and I kind of went long. Airspeed is life. Well, it could be the beginning of a crash, but we gotta go down like 20% before we call it a crash. We're in the red, but yeah, we're substantially in the red. But let's see where we get tomorrow. We're having a good January, okay? It's not like, oh man, it's just been a terrible January. We keep selling off. Okay, so let's let it kind of play out. And then Bitcoin's down also. Yeah, Bitcoin is down. Hit 109,000 per coin in the last week and a half, and now it's down to 101,000. Okay. All right. Well, we're not, these markets, right? They don't go up perfectly, in a straight line. They got this adversity. But don't forget to look at the number. From start to finish, the NASDAQ is up 29%. That is a beautiful number. 29%. With that number, every 2 years, 8 months or so, you can double your wealth. If you have $100,000 at a 29% rate of return, less than 3 years from now, you'll have $200,000. If you have $500,000 in less than 3 years, you'll be a millionaire. If you have $1 million, 2 million. So rate of return is awesome, but it doesn't happen with a smooth line. So if we're faced with a down day tomorrow, let's say that NASDAQ sells off by 2%. No big. We deal with that. Okay. But if we buy quality companies, these companies are going to be valuable, period. They're going to make money. They're going to have cash. They're going to load up their balance sheets. They're going to buy back shares. They're going to acquire businesses. If other businesses get sold off and they, go down in price, stock price, those strong companies will buy those other companies. So if we buy the right businesses, we go up in value. It's going to be with the, some down days, some up days, some crazy up days, some crazy down days. That's part of the game, baby. But airspeed is life. Thanks for joining. I don't know if you've been on before. Nonetheless, thanks for joining. Michael Anthony, you agree. Apple looks bad. So Lyft. And I'm going to read off the comments and make some notes and then come back just so that you guys that are providing comments don't feel like I'm ignoring you. We're going to talk about Lyft. Hang tight, Michael Anthony. I just noted it. And then we're going to talk about, so on Shul, I talked about NVIDIA at length. And the moral of the story is that the stock hasn't been moving for 6-7 months. Super important stock, most valuable stock in the market now. So we'll see. And my general opinion is that I think it's overpriced by about 40%. Brian, Chewy stock. I think there's a lot of pet owners because Chewy stock comes up a lot. We can look at it, most definitely. Brian, do you have a pet? Are you like a Chewy fan? Like, oh man, I love buying stuff for my pet on Chewy. To Rio Neal. WM. Take a look at that. Just hang tight. Michael Anthony. So you think in healthcare stocks, you'll see some profit taking? Could be. Just long term, I mean, the space is a necessity. I think it's going to make a lot of money. We'll see. Brian, you got stung on ASML, CBS last year. Yeah, I mean, I didn't get stung on ASML, but that was a big surprise. I think ASML is a really valuable business. They got hammered, and it was like, they're still growing, but I understand. And then CVS, of course. But CVS has been moving this year. Put gained huge on Super Microcomputer and Onto last year. Cool. Congrats. What's Onto? Let's take a look at ONTO. Never heard of it. Ivan, Cisco. Bringing back some of the original gangster technology companies. Tomas, what's up, man? Good to see your name. I hope you're doing well. Can we look at BBD, Banco Badresco? Absolutely. We're going to look at BBD. All right. So airspeed is life. You're new. You're a naval pilot doing trading on the side. Cool, man. That is awesome. Man, I would love to live life in your shoes for a couple days and fly one of those awesome jets. For now, I'll stick to the video games. Okay, I just know Americans. So, Brian, Americans love their pets. I agree with you. I agree with you in sentiment. I think people love their pets and they pay cash. See, when we talk about Chewy, I'll mention that. All right, so we're going to talk about Chewy, but good comments, guys. Thank you. We are 30 strong. We got up to like mid 30s, which is really cool. Really appreciate everybody joining. All right, so I'm going to take BBD on. Oh, BBT. Banco Badresco. Together with its subs, provides various banking products and services to individuals, corporates, and businesses in Brazil and internationally. The company operates through two segments, banking and insurance. It provides current savings, click, salary accounts, real estate credit, vehicle financing, payroll loans, mortgage loans. Okay. This is a bank in Brazil. Okay. Man, it's really sold off. 74%. 19.6 billion market cap. Revenue is 13.85 billion. It is profitable. Earnings per share. So the PE is really low. Very high dividend. Analysts believe it's a very discounted stock. So banks, I don't value based on free cash flow. It's not the appropriate model to use. I usually want to see with a bank that they are growing their book value, which represents the value of a bank, and they have a very strong earnings per share valuation. So looking at their book value to begin with, and while I'm in their financials, I want to look at their revenue growth and so forth. So it looks like their net interest income has been struggling. It's kind of been a positive negative, situation, like in 18, very positive, slightly negative in 19, positive in 20, positive in 21, negative in 22, negative in 23, negative in the trailing 12 months. So that's a concern. That's like, whoa, why is it so negative? Yeah. And the quarterly doesn't help. Now, banks in the US, like Citibank, JP Morgan, they've been doing really well. So this bank isn't doing well. Now, I'm not an expert in Brazil, but I do own Citibank. I own JP Morgan for a long time. So their revenue actually grew. Their interest revenue didn't grow. And non-interest income is where they grew. So they're doing other services outside the bank that are growing. Okay. So earnings per share has been a little rough, or I should say unpredictable. Positive, negative, positive, negative, negative on the growth side. So it's been unreliable. It's not like a consistent upward trend. So on the balance sheet, I'm going to be able to see their book value. And so their book value has been growing. So that's a positive. So they present a number of like red flags, and I mean the stock that I like more than this is New Holdings. And let me get reacquainted with New Holdings. New Holdings is also down in Brazil, but they're also in Mexico, Colombia, Cayman Islands, Argentina, Germany, Uruguay. They're a bigger market cap. PE is decent. They're also discounted. So I just think these guys are more prosperous. They've got some momentum. I think when we look at their book value, it's gone up incredibly well. Like you look at this chart and it's like, wow, that's a really good chart. Okay. So when I look at the fundamentals of New Holdings and compare them to Banco Badresco, There's really no decision. This is a stock I'm buying, and I think I'm good. I own most of my stocks that have U.S. related businesses or are based here in the U.S. and very dependent on the U.S. economy. So it's nice to invest in new because, hey, they're, getting me access to the Brazilian economy, Mexican economy, Colombian economy, and economies that give me a little more diversification. So that's good. But their fundamentals look really good. Revenue growth, book value, earnings per share. Analysts agree that, hey, they're discounted. So I think this stock could be worth quite a bit more in the future. This company doesn't have momentum. It's not as well known, at least not to me. It seems really risky. It does have some pieces to it that look pretty attractive. This PE is super low because it's sold off. The dividend, okay, they should change this dividend. If anything, to me, it's a negative to have such a high dividend because it immediately makes me think it's a risky stock. They shouldn't have a dividend that high. If they're a bank, it should be like 3%, 4% is really high. 2% is acceptable in the US. So my comments, Tomas, are this one here. If you really, really believe in them and can really understand them, analyze them well, and you feel like, the market's got this company wrong, I'm gonna take a pretty high risk and buy into the stock. You may get a high reward, but my senses are that this stock is probably going to stay down here for a long time because it got there for reasons. It sold off. Investors didn't like some of their fundamentals. You saw that it's been kind of a rough, green, red, green, green, red, red on net interest. And if you can't hold your revenue and show a consistent growth like new holdings, the market it's not as confident in your numbers as they are with other companies that are competing for investors to buy their stock. So this one here, not as good, higher risk. It's your decision, but that's what I'm seeing. I don't like these I don't like these fundamentals. I like these fundamentals. It's a better choice for me. And those are my comments there. I appreciate you bringing it up. All right. So I'm going to carry on, and on the comments, I'm going to come back to them and pick up where I left off. So I think next one on the list is Lyft. All right. So Lyft. This company 15, 20 years ago was going head to head against Uber, and they lost. So now it's kind of a discounted ride sharing company. 5.7 billion. Revenues almost 1-to-1. Forward piece 13.6. The 1 year, okay. 5 year, very bad. Okay. So revenue growth looks really good. So revenue, man, they're growing really nice. High revenue growth looks good. Okay. Cost is there. So in the annual, good. Producing some free cash flow, although they had some negative cash for a while. Looks like they've made the turn recently to be positive cash flow wise. Gross margins look good at 33.88%. And free cash flow margin looks good. So that looks good. Now I'm going to look at the quarterly because the free cash flow, they just went positive, which is good. It's a very good sign. And yeah, it looks good. They actually made the turn in the fourth quarter of 2023. They haven't announced the fourth quarter of 2024 yet, but looks like they're making money and they're generating free cash. Very good job, Lyft. So, balance sheet. They have more cash than debt. Good job. Very good. Now they're generating free cash flow. Company's up on the up and up. If you're generating free cash flow and you're growing, they're growing faster than Uber, but Uber is a lot bigger. So let me open up Uber. So Uber's 16.7%, but they're a $42 billion company. Lyft is like 5.4 billion. So it's like Uber's 9 times bigger. But this growth rate is not lost on me. That's a good growth rate. That's a very good growth rate. And it's a discounted stock right now. So we saw that cash flow is good. We saw that revenue is good. Profit's good. Analysts, 32 of them cover this stock. Wow. That's a lot of analysts. Worst case scenario, $10 stock. Best case scenario, double your money. Yeah, now we're talking. We're either going to make a lot of money or lose a little bit of money. I mean, down 30% isn't like the worst in the world. Okay, forward 2025, which is the year we're in. They're going to keep growing at a good clip. Good. Profitability is really going to expand. Good. PE is going to be good. Okay. I like what I'm seeing. Lyft looks really good. Okay, so the forecast looks good. So their free cash flow was so this business could be worth $12 billion. No questions asked. This is an interesting situation. I'll tell you one more thing that can happen. So these guys, they lost the marathon to Uber. They lost the war, but you don't have to win the war to be a valuable stock, especially with a small cap. You don't have to win the overall, ride sharing marketplace and reward your stockholders. These guys are making money now. They're generating free cash flow. And what I would say is they are a takeover target. Can somebody acquire Lyft and use their network, use their customers, bring them into a business like an Airbnb, bring them into a business like Booking, maybe, I don't know, Google Alphabet or some private equity group says, hey, let's take this private. We'll grow it. We'll do an IPO. We'll come back at 20 billion. And when they acquire all the shares, they'll pay all the current stockholders like a nice premium, 40%, 50%. And I'd be happy with that. Like, hey, if I own shares and somebody automatically says, hey, we're going to give you 40% more for your shares, I'd be like, yeah, where do I sign? So I see Lyft is pretty darn attractive. I appreciate you bringing it up because, it's interesting. Like I probably looked at Lyft 2 years ago. I made a decision maybe 3 years ago. Hey, Uber is a better choice for me. I'm glad I bought Uber, and Lyft I hadn't touched. But now Lyft is going to be a stock that I'm going to look into further. We started off with Met for MetLife. That's a stock that I'm like, man, I'm going to look at it one more time. I might start buying shares this week, especially if we have a sell-off. That's when it's like a really good idea to buy some shares, right? When prices are being sold off. So I really like Lyft. Who asked about Lyft? Who asked about Lyft out there? Michael Anthony. Yeah, so I think lift's good. All right, so got through that. Let me keep rolling here. Let's talk about Chewy. And I agree with the comment that people like their pets. I totally agree. And that's just not in the US, by the way. People love their pets in Asia, Latin America, from stories I read and when I travel, people like pets. Chewy has been wow. Now during COVID, everybody's buying like all kinds of Chewy stuff online, so the stock got really, really uh, expensive, and then it sold off. For the 1 year, it is cranking. Isn't that interesting? It sold off from its high, but in the 1 year, it's really rewarded stockholders. It's almost doubled their investment in 1 year. Very good. Revenue, 16 billion market cap. Revenue is 11.44. 4P is a little high. Analyst thinks it's a little expensive by 6%. They are growing, but their growth is slowing. That is a concern. All right, so their growth is slowing. It's becoming a slow grower. And so free cash flow, 363 million. Trailing 12 months looks good. Profit margin. Man, the gross margin's 29%. That's fine. Yeah, they're an e-commerce company. That's fine. Looks good. That kind of is similar to like Amazon for their e-commerce business. So 363 is their free cash flow trailing 12 months. Balance sheet. Okay. They have almost as much cash as debt. Looks good. So 388. Yeah, the best I can do on this stock is I could probably get to like $11 billion of value. So this one's a little too expensive. So this one would be a pass for me. There's another. So there's a combination of things. Like the slower growth to me is a big problem. That means that customers could be going to Amazon instead, because Amazon's going to have a lot of this stuff. I would say that Chewy does a better job at providing a user experience for somebody who owns a pet. Maybe, hey, I have a particular type of dog. What kind of products can I buy to make my dog healthier, or that kind of thing. Where Amazon's not going to do that. They try to be all things for everything, and they don't provide as good of an experience for a pet owner. But if your revenue is declining or your growth rate is really slowing down, that might mean that Walmart and Amazon and your competitors are beginning to erode your market share. So that combined with the valuation's gotten a little expensive because they don't produce a lot of cash. It's a pass. I think it's a business that's worth like 12 billion. Hindsight's 2020, right? A year ago, obviously this was a good buy. If you bought it at $15 a share, the market cap would have been around 7 billion. And hindsight's 2020. Yeah, it was a good buy then. But now it's beginning to feel like it's a little too expensive. Forward P is high. Even analysts are saying it's priced too high. So Chewy is a pass for me. Thanks for asking. Okay, so I think the next one is WM. So Waste Manager, every time I look at this stock, it just doesn't value very well. The Waste Management collects like garbage and they do waste management. It's in the US. It's a necessity. They get put into the industrials waste management sector. For the 5 year, it's doing fine, man. You add that dividend on there and you're up at 80% return. So that looks good. The 1 year looks decent. You've got a 12.88% appreciation rate. You add the dividend, you're up to 14. It's not bad for an industrial. It's not bad at all. But every time in the past, when I look at it, because I'm interested in this business, it's like, hey, this is a necessity. This is not going to go away. It's almost like Union Pacific. It took me a long time to buy into them because it was always priced at a very high price, and I had to wait. Finally, I've been able to buy some shares. Their growth is there, 6%. Looks good. Revenue is $21 billion. Okay, that looks good. And free cash flow, $2.1 billion. Now they haven't grown free cash flow. You see that? I'm going to say that it's been relatively flat, kind of plateaued on free cash flow for many years. That's kind of concerning. Gross margin is okay at 39%. Okay. So if they're a 2.1 billion free cash flow company, they're a slow grower. Let's take a look at their balance sheet. Make sure they don't have a bunch of debt. So their debt is a little high, 16.65 billion. So let's call it they have 16 billion of net debt. So yeah, this is a pass for me. I would get a valuation of roughly like 40 billion, and then I'd have to deduct that debt. So I'm down to 25 billion. So well below their market cap. And it's because they haven't grown their free cash flow. Free cash flow has been pretty much like plateaued. And if you study like a company like Microsoft, which is near the top of the food chain, right? And you look at free cash flow, 2018, 32 billion. 2024, 74 billion. They more than doubled their free cash flow. And it's now this freaking nutty number of $74 billion of free cash. That's how you create super valuable companies, is you have this expanding free cash flow. And our friends at Waste Management are not expanding free cash flow. So I've looked at Waste Management in the past, and that's where I break down. I'm like, why are you not growing their free cash flow? You can play around with earnings per share, right? Earnings per share is easier to manipulate for management. Not saying they do that, but Charlie Munger would have said that when he was alive. He didn't like earnings per share. He liked free cash flow. And these guys, consensus is that they're discounted by 10% because they have good earnings per share. They get a very high multiple. I don't like the multiple. So I have to pay a high multiple on an industrial stock that's just growing mid-single digits. No thanks. I'll go find something else. Like 3M is a nice industrial that I'm buying into, and other industrials look good, like Lockheed Martin. That looks good. That's an industrial. And I'll stay away from Waste Management. Waste Management is not good enough. Let's talk about Cisco. So Cisco is a very well-known technology company. It's been around for a long time. I made money on the stock recently. I bought here. I sold recently at the end of 2024. Took a nice gain. Thank you very much, Cisco. I think Cisco is a good business. It's now priced a little expensively. I agree with that. Do I still track this stock? I don't know if I do. So I still track Cisco. I think they're priced 7% too high. I have a lot of respect for the company, but it's kind of their growth. See, I'm 7% too high. Analysts think they're 2.27% too high. They're not growing. Okay, so we got to be realistic. It's like, why aren't you growing, guys? I just showed you Microsoft. They're growing. Google Alphabet's growing. Meta's growing. So why aren't you growing? And that's a big problem. You have to be very careful with these non-growers. They're called value traps. You can get into them and be trapped and lose money. So these guys here, for me, it's a pass, right? And I just took you through the journey, a positive journey with Cisco. I bought the right time. I sold at the right time, made money. Thank you very much. Move on to the next one. Their free cash flow is decent, but it's plateaued. You see that. Remember, I just showed you Microsoft. They more than doubled from 2018 to 2024. These guys went the wrong way. They went from 12.8 billion down to 10.2 billion. So that's not good. That's a plateau situation. So Cisco is a pass for me. But let me tell you, if Cisco's stock price were to get back down to $40 a share, I will jump on that stock in a heartbeat because I'll probably make money again. Because that's just that's a good company. They make money. They make good products. So stock market, you want to bring it down to $45 a share, I will buy this stock and probably make money again. So thanks for asking about Cisco. All right, everybody. I think I'm going to have to call it. I am beginning to get fatigued. Let me see if I can answer a few questions before I say goodbye. Yeah, we've been going for 2 hours. No wonder I'm tired. All right, so all right, good luck with Chewy, Michael. So Lardog, sorry man, I can't review AOS. I'm just ran out of time. I apologize. But if you want to show up to another live stream and put it out there, I'll try to cover it. Then Michael Anthony, sorry. Pags, I can't cover it tonight, but maybe on another occasion. Yeah, SoFi, I think, SoFi is a crowd favorite. I could do a quick comment on that. And they're going to get announced tomorrow, so it's going to be super exciting. They're probably going to be the exciting stock. I just think there's better options for me. I did really well with Robinhood. That's probably what I picked ahead of SoFi, back a year and a half. And I'm very happy with Robinhood. And instead of SoFi, I'm buying into new holdings. SoFi's done really well over the last couple months. But, some people love SoFi. I think there's better options. And congratulations. SoFi stockholders made money. I made money. That's great. So Lyft, good one. Thanks for bringing that up, Michael. All right. So Sabir 2. So I dug a little deep into Lyft, and I am going to look at it further. So I'll probably make a video on my channel if you want to come back to the channel and keep your eye out for the Lyft video. So Bill Gates owns Waste Management. Yeah, he owns some he owns railroads and stuff. I mean, that guy's got a lot of money. I think he buys businesses that are necessities. JBL, again, please tune into another live stream. I'm sorry I can't cover it, but I got to call it a session. We've been going for 2 hours. So, and then Bros, too late to buy. Is that, is Bros, Dutch Brothers? That's a neat coffee shop, but I haven't looked at their stock in a long time. Yeah, I mean, if we look at if we come back to another live stream, Michael, we can go new versus Pags. So sorry I can't get to those guys, but big thanks to everybody. We're 23 strong. We got up to like 35 strong on the live stream. That was awesome, guys. And that's really, really good. And I appreciate it. I appreciate the interest, the support. And please understand we've been going for 2 hours and I got to call it a night so I can go get some dinner and then shut it down and be ready to do some investing. But we came out of today's session, the 2 stocks that got the gold stars, MetLife, Snoopy's company, and Lyft. Those are the 2 stocks that I'm going to dig deeper, potentially invest in. We covered about 12 different stocks, maybe 14, and kind of went deep on some of them. And really appreciate everybody tuning in. It's going to be a big week. Everybody tune in. And looks like the market is still in sell-off mode. We'll see. No problem. Stocks go down. Probably give us better prices to invest in great companies. No big. And please come back. I'll try to live stream a couple times this week, and I'll try to announce it with some time. But come back. Love to see your name again. We'll talk stocks. I'm sorry for the stocks that I couldn't get to. And like MicroStrategy, we can talk about that one on another session. And we can talk about RKLB. Sorry I couldn't get to them, but on the next one. All right, everybody. Have a great night. Thanks for tuning in.